Hello and welcome to the GIC College of Central Bankers Conversation Series. I am Kathleen Stephansen, Vice Chair of the College, and today we will explore the European Central Bank's monetary policy. To help us understand the challenges of the ECB, we have the honor to be joined by Jose Manuel Gonzalez Paramo, a fellow of the College of Central Bankers and a former member of the executive board of the ECB and of the governing council of the ECB. The governing council is the Eurosystem principal policy-making body. He is also a member of the Committee of the Global Financial Systems for the BIS, chairman for Europe's of the Transatlantic Business Council, and executive board member of the BBVA. And he has held many academic positions. And I could go on, but I'll stop here. And Jose Manuel, welcome, and thank you again for joining us. Now, before we dive into the ECB policymaking as such, could you say a few words about the inflation situation in the euro area and how it might differ from the US, at least initially when you started to see the first impulse of inflation back 18 months ago, how they differ from the US?
Yeah. First of all, thank you for this invitation. It's a pleasure for me. If I could add some light to the understanding of events, economic events in Europe. Well, the inflation situation in the US and the Eurozone have some factors in common, but also some idiosyncratic differences. In common, we have, of course, the pandemic in the origin and its impact on the so-called pent-up demand. So when uncertainty came, people started to contain spending. And this spending came back when more certainty was present in the environment. Also, the issue of bottlenecks. Bottlenecks have impacted both sides of the Atlantic in regards of prime materials, transport, labor, and so on. Third, I will mention the delayed impact of monetary policies. Monetary policies were very expansionary in the years before the pandemic, and this delayed impact was visible also in the inflation situation. Now, as the idiosyncratic part, as I see it, I see the main difference has to do with the role of fiscal policy. Clearly, in the US, the fiscal impulse was massive. By all standards. If you take into account that in 2020, the US passed five fiscal programs, five relief programs amounting 3.3 trillion US dollars. And in 21, the American Rescue Plan amounted to 1.8 trillion dollars. I mean, this is in the ballpark of 20% of GDP, when the output gap was negative around 2%. So compared 20 with 2%, it looks like it was overly expansionary, the fiscal policy, and this had, of course, an impact in the inflation situation in the US. To a difference, in the Eurozone, fiscal policy could not have such an impact, if only because many countries were constrained by the fiscal situation. They did not have fiscal space. This was particularly the case of Italy, but also other countries. So in almost no cases you saw fiscal programs in excess of 10% of GDP. So it's less than half of the amount, comparable amount in the US. What is more idiosyncratic to the Eurozone is, first of all, the size of the monetary policy expansion, which was really huge before and during the pandemic. And secondly, of course, the direct impact of the invasion of Ukraine by Russia, which has impacted, in particular, energy, the availability and the price, and also the availability of food supplies. So it's more of a supply shock in the case of the Eurozone as compared with the demand shock that you see in the US, justified, of course, by the consequences of COVID.
Right, and I'll come back. I'd like to come back to the energy issues and the shock there. But when you look at the difference in the fiscal response, I mean, the U.S. it was essentially distributing checks to the population, whereas in Europe the focus was much more in terms of keeping people employed, and so obviously there is here a smaller fiscal impulse, but would you characterize that fiscal impulse then as being more precise in terms of, the output gap being, negative, let's say, for the sake of the argument, 2%, and that this fiscal response was close to a plus 2%, or actually a bit more, obviously? Would you say that it's a more targeted fiscal response, or not necessarily?
No, I wouldn't say. I mean, it's not that necessarily. Of course, it was good news that we saw for the first time, and it looks like it will stay, the money that went to keeping people employed. Now, companies have learned how important it is labor holding when there is scarcity of some skills. And this explains why, in spite of growth falling quite significantly, you keep unemployment at record figures in the Eurozone. Is labor hoarding, and many countries, including mine, learned the importance of keeping employees linked to the company instead of trying to find the right skills 1 or 2 years later. But this, of course, was really targeted. But for the most part, I think it was the possibility, the fiscal space. Many countries did not do what they wanted because they could not, basically. This is a fact. And it was key, another thing which is different to what you see in the US, which is for the first time, you have been the rolling out of a program quite sizable in volume, 800 billion, which for the European standards is quite significant, called New Generation EU, that is addressing investment needs in the digital, the environmental, and the inclusion areas. And these funds were distributed according to the impact of the pandemic. So Italy and Spain were the main beneficiaries of those. And those are clearly targeted to this investment needs in the digital, the environmental, and the inclusion areas.
And one can argue that that's more of a multi-year type of
yes,
investment.
absolutely.
A little bit the infrastructure or the IRA Act that we see here in the US, which of course came much later than, that's interesting.
You're right.
Let's turn to the ECB. I mean, it's quite interesting. So obviously the ECB was very aggressive, in response to this inflation impulse, raising the rates from minus 0.5% back in July of last year to now 4% with the latest 25 basis point increase this past September. Now, at its meeting, the ECB mentioned that the underlying price pressure remains high. What you were talking about, the bottleneck and so on, I think everybody's recognizing that these have ebbed, that's no longer the main trigger for inflationary pressure. But do you agree that the underlying price pressures remain high, particularly now that we saw in September that the August numbers were, the September's number were it was August, right? The August numbers were slightly lower than anticipated.
Well, if you look at the core inflation figures, you see that there is some resistance of those to go down, which means that many price pressures are in the pipeline and might impact headline inflation. So in that sense, I understand the cautiousness of the ECB, because at the same time, the central bank has signaled that they will remain vigilant as regards the incoming data, because the inflation numbers that you mentioned, which were September data, because it was the flash estimate for the September month, came lower than expected, which is great news. Almost for the first time, we have good news in the inflation front. But still, there is no room for complacency here. So pressures remain non-negligible if you look at the core inflation area. And also wage demands have increased. There are out there multi-year wage agreements in excess of 5%. And also margins have been very strong in some sectors, including metals, including agriculture, and so on. So to the extent that those pressures, those dynamics remain there, you have to be quite attentive to developments.
And that's where I think the crux of the challenge is, right? Because on the one hand, as you mentioned, price pressure in the pipeline, you can argue that there are also, the tightening pressures from the past policy, past policy actions are also in the pipeline. We don't exactly understand, and I think the same is here in the US, we don't exactly understand the leads and lags of the policy decision-making. So that's on the one hand. And on the other hand, like the ECB mentioned, they revised up their inflation forecast for this year and next based on higher energy prices. Mm-hmm. And we all know that energy prices is one of these developments whereby it's very hard for interest rates to really pressure it down, except that if you want to really crush demand, right? So that's a challenge and a balancing act that the ECB is probably following. So what does that mean? Continuation of rate hikes, or as now the conversation is pivoting here in the US, the higher for longer?
Yeah, no, you are right in listing the main considerations that are in all the conversations at the ECB level. You have a delayed effect from monetary policy, and you really don't know how long these lags will be. The reaction function of the ECB has been made explicit by President Lagarde a number of times. So they are looking at headline inflation and the prospects of it, core inflation, and the transmission mechanism. And you have to look very deeply into it, because after the pandemic, a number of things appear to be different. But on the other hand, you cannot be blind to the pressures as regards wages and profits. And you mentioned energy. You say, okay, energy, you cannot do much. But what is indeed true is that the projections of the ECB are based on oil prices in the ballpark of $90 for the next year. And recent forecasts that you find are in the ballpark of $100 per barrel. So this will put a pressure on inflation. Of course, monetary policy cannot do much against energy price increases, but certainly they cannot be complacent in the sense that inflationary expectations could drift up, and it will be harder later on to bring them down and facilitate inflation coming back to 2%, which is a reference. So it's a very uneasy situation for central banks having to fight supply side inflation, but they have to, because otherwise the credibility of the bank will be lost. If inflation remains long, no matter how convincing you are explaining, look, I can do nothing because my policy is demand side policy. Mm-hmm. If inflation drifts up and goes into inflation expectations, you are lost.
Right. But and the challenge here, actually, on both sides of the Atlantic, is that it appears as though the economic numbers are surprising on the upside, certainly in the US, but even in the euro area, many economists had predicted recession to take place, by mid-year at the latest. And here we are. We can argue that, well, the cyclical indicators, the sentiment indicators point towards recession, but so far that hasn't happened. Why is that, do you think? Is it that policy actually is not as tight as we think it is, or there is a resiliency that we missed, if you will, in the economy?
No, I think you point to the right reason. I mentioned the changes in the labor markets as a consequence of incentives for companies not to lay off in the face of difficulties in finding out the right skills. Mm-hmm. So the strength of labor market has to do with this change in behavior, which is not so much a novelty in Germany, because they traditionally had this policy, but certainly in other countries like Italy, Spain, or France. So the resilience of the labor market is explaining why you don't see lower numbers on the inflation front. Also, a number of things have been done in the energy front that allow companies to be more optimistic, in the sense that you see, for instance, gas reserves are 100% filled at the moment, in preparation for who knows what kind of winter we have ahead. Last year, we were lucky because temperatures were such that there was no need to go into emergency mode. But having the guarantee that at least gas is available for companies, in particular in Germany, is a good thing. So indeed, there are headwinds out there because world trade is decreasing, is diminishing. But on the other side, supplies are more certain as regards the energy, and labor market is resilient. And this is why I think we don't see recession broadly. Rates of growth indeed have fallen quite visibly. You see the expectation for this year is 0.7% growth, which is not brilliant, but it is not negative.
Right. And yet, there is the latest blue chip indicator, more than 50%, slightly more than 50% of the panelists are looking for recession in the euro area. And similarly, they're looking for recession in the US, but later on. And as a result of that, also, I think there is an expectation that this is it for the ECB, that they're no longer, we'll see. I think that, both obviously projections from the private sector and the public sector, the ECB, I'll ask you about that, but certainly the Fed has become extremely data dependent. And do you feel that that's the same at the ECB?
Absolutely. It's entirely data dependent, and the Chairman Lagarde insists on that meeting after meeting. So the last meeting, the Q&A part of the press conference, she was very clear. So the impression that she left was that possibly these rates are sufficiently restrictive so that if maintained for a sufficiently long period, they will tackle the inflation problem. But, and this but is in capital letters, they will remain data dependent. So meeting after meeting, they will revise this assessment.
Yeah. You touched just earlier on. You touched on the fact that the fiscal policy allowed for people to remain employed, and that contributed to the continuation, if you will, of pent-up demand. Now, a major difference, though, between the US, and I apologize coming back to this comparison all the time, but for our audience, I think it's helpful. In Europe, the savings rate has not really plummeted the way it has here in the US, which partly has explained, but not entirely, the resilience of the US consumer. In Europe, is it more the fact that the consumer feels that, employment is safe, and as a result, there is this tendency to spend more, or is there other factors involved, given the
No,
savings rate remaining high?
no, I think you are right. What it means, in my view, another way to see it, is that there's still some reserve, some savings not spent after the accumulation in the pandemic, which means that to the extent that uncertainty diminishes, it will come. And of course, the implications are mixed if you think of inflation, because now the demand may be rather or relatively contained, and the problem is basically pipeline effects and possibly energy surprises. But going forward, you may see again demand pressuring on capacity.
That's it. So let's turn a little bit on to the transmission mechanisms of monetary policy, and how, in your assessment, what is more effective as a tool? Or maybe you might say, well, it's both together, but is it the management of the balance sheet, or is it the interest rate as a tool? And I'm particularly interested in your view on the potential asymmetry that we find when a central bank is confronted with tightening monetary policy or easing monetary policy. To what extent these two tools, if you will, or set of tools, play a larger role?
Yeah, to me, the main instrument of central bank has always been and will be rates, the interest rates, the main reference rate. Is, as you hint in your question, is quite symmetric. You go as easily up as down, whilst for balance sheet management, there is an asymmetry, because bringing back the balance sheet to the size it had at the beginning of the period, it takes a long time. You cannot very quickly, sell assets unless you are causing financial impacts that you don't want. So I always thought that the main, I would say, positive element in balance sheet management has to do with commitment of the central bank to keep rates long rates for a long period, and you commit yourself to the extent that if you don't fulfill your promise, you will register huge losses. And this is the commitment. And now you see that central banks are going into sizable losses, and that could impinge upon independence. So to me, balance sheet management has to be an exceptional or a non-conventional tool, to be always in the toolkit of the central bank, but to be used only in very, very limited circumstances. Whilst the rates are the natural element, a natural instrument of policy, and it will always be, to me, the instrument to think about.
Right, but this is it is a challenge, though, right? In the sense that, the exceptional usage of that particular tool is becoming more and more prevalent, given the volatility. One can argue the volatility in the cycle, and how the central bank tries to compress that volatility. We saw that post the 2008 Great Recession. We saw it after the 2012 situation in Europe, and we see it now after post-COVID, right? So it becomes almost more and more the norm, I think, the QE and the QT type of development.
Well, as I said, keeping it in the toolbox is right. But to me, thinking of it as the usual means of intervening in the markets is not a good thing, because it's rigid, it's asymmetric, and in occasions where you need to tighten quickly, and you cannot use this instrument as quickly as you would like to,
Right.
because you create financial instability problems. So I think there are ways to reduce volatility, being very transparent to the markets, explaining the situation, being clear about your reaction function. And I think this is an avenue that central banks are walking more and more,
Right.
instead of using the balance sheet.
Yeah, yeah. So turning a little bit on to financial markets, if you will, what's puzzling is, and it might not necessarily be, so the ECB was the central bank that raised rates by 25 basis points in September. The BOE kept it unchanged, and the Fed kept it unchanged, and yet the euro weakened. Tell me a little bit about that. And of course, nowadays, even this morning, you see the dollar strengthening again. So is this related mostly to the sharp rise in long-term yields in the US?
Yeah, maybe this is the case, but certainly it's not, I think, a direct consequence of the ECB deciding to increase whilst the others kept rates at the level. Of course, there is always this difficulty to explain exchange rate movements that we cannot overcome at these moments. And if you look at the evolution of the exchange rate of the euro vis-a-vis the euro has been falling since mid-July. And in fact, the 4 days after the decision to increase rates, it appreciated in a very small amount to afterwards continue the downward trend, from 112 to 106 to the dollar. So it may be related to what you refer, but the possible causes of the depreciation of the euro, in my view, have to do with the falling expectations as regards growth. Growth surprises are not good. We don't have a recession, but the expectations for growth are being revised progressively down. And this has an impact. And the oil prices have to do also with this, and energy more generally. So Europe remains quite dependent on imported energy, and this has an impact on growth, and this perhaps is what's behind the evolution of the euro at this point.
And that presumably should make the ECB's job harder.
Yeah, indeed, because imported inflation will be an additional element to fight at this very moment, because of course the Eurozone exports a lot, but also imports a lot of goods and services, and this will mean that a lot of imported inflation will be there if the trend continues.
Yeah. If we may, I'd like to just circle back to energy and your comments on the energy markets or commodities in general. We've been surprised to see the flexibility, in fact, and the ability of the euro area to really adjust to this external shock that was the invasion of Russia into the Ukraine. I mean, is this a permanent situation that in fact will be growth supportive, given all the things that we're seeing, regardless whether oil prices 90 or 100? Obviously, assuming that there is a transition, because it can't just be switched quickly.
Yeah.
But is that a point of optimism in the euro area economy?
No, indeed it is, because if you look into the figures, you see that in particular households and companies have started to put in place energy-saving technologies to an extent that have surprised even the more optimistic. A lot of investment is being put in building isolation, and solar and renewables are now. This is another of the bottlenecks because demand is huge for this type of supplies, and you don't have the solar panels on all the other sources of renewable energy that are being demanded both by companies and by households. So in that sense, this is a reason to be optimistic going forward, that the transition is happening before our eyes. Yeah. And this might mean that we will be relatively independent from imported energy, particularly from the East, sooner than we expected.
But one thorny issue is nuclear energy. Is that correct?
Yeah, yes. There's a division, as you know, views about nuclear. France is fully for it, but there are other countries, including Germany and Spain, that are very skeptical about the role of nuclear energy. Let's see, because this is now hotly debated in Europe. Nuclear energy has been considered clean energy in the European taxonomy. And this is more of a political agreement, of course, than an objectively and widely shared view. But it is indeed an issue of nuclear energy going forward. Of course, nuclear energy production has changed a lot, and you now have centrals that are cleaner and safer than in the past. But nonetheless, the discussion remains there and is quite political, I have to say.
Yeah. Plus, I guess that it takes maybe less nowadays, but it takes time for a nuclear,
Absolutely.
center to be built and so on.
Yes.
I think I would be remiss to, conclude here if we didn't say a couple of words about the global economy and where do you see that in the context of the euro area and the ECB policymaking?
Well, as you see from the figures, we are in a quite volatile situation. We were expecting a catastrophe in China, and it doesn't look to turn out, which is, in a way, good news to countries that export to China, because it's a significant part of global demand. For the rest, we have these question marks from the US and the Eurozone in terms of how far growth rates will fall. Because you mentioned recession projections. Those that I see point to a diminishing growth, but not in the negatives. So let's cross fingers and let's hope that the environment remains sufficiently benign so that the soft landing is more and more the central scenario. I mean, this is what I'm counting on at the current moment.
Well, that's a very optimistic, well, or let's put it this way, an encouraging view. Just as a conclusion, Jose Manuel, we tend to always be pessimistic and say, what worries you the most? And I'll invite you to respond to that question, but I also would very much like to know what, in your view, is the most encouraging developments that you see over the next year and a half, let's say?
I mean, one of the encouraging developments, at least in regards to Europe, is the situation of the banking sector. I think it has been put to the test this year. And when you look at the stress tests that have taken place, you see really resilient banks. And you have to remember that the Eurozone is depending on banks at least 2/3 of the financing. So to that extent, and to the extent that the financial flows to the real sector remain safe and secure, we can be sure that, okay, credit is going down, but it will not plummet due to the financial crisis. Question marks remain around the non-bank sector. I think the IMF and all the financial stability authorities are trying to put a focus on non-bank financial sector. But to me, one of the good news is the resiliency and the strength of the balance sheet of the banks at this side of the Atlantic.
So do you think that, you know, this success, if you will, would delay the, you know, the impetus or efforts to broaden the capital markets to make it a unified euro capital market? Because it essentially tells you that, well, you know, why change given that, you know, here we have a very solid, you know.
Yeah, no, I don't think it will impinge on that process. On the contrary, banks, for instance, need unified capital markets in order to securitize assets. You cannot sell securities in the European market. You sell securities in your local market. And this deprives banks from the opportunity to confront wider markets. We need the capital markets, you know, for many reasons, including the role of the euro as an international currency. So in that sense, having a strong banking sector doesn't mean or has no implication as to the need to build a truly integrated capital markets.
Well, on that very positive note, because it is such an important element of the euro area financial system, I really want to thank you for joining me in this conversation, and hopefully we can in the future resume this and see if, you know, all what we discussed about, you know, turned out the way we anticipated. Thank you very much, Jose Manuel.
Thank you very much to you, Kathleen.